Let's look at the economic legacy of Manmohan Singh's 2 terms from 2004 to 2014, and then compare it to Narendra Modi's tenure from 2014 to 2026. Depending on who you ask, you'll hear completely conflicting claims. Voters and investors are flooded with stories of golden eras from one side and economic masterclasses from the other. This table compares the 2 eras side by side using the baseline numbers. On the left, Singh's period shows an average headline growth of about 7.6%, with average inflation running between 8 and 9%. On the right, Modi's pre-COVID average growth sits lower at 5.9%, but with a much lower inflation rate of 5 to 6%. But treating these raw numbers as a pure scorecard is a trap. In 2015, India's GDP calculation methodology was revised with a new base year. This break in the data makes direct historical comparisons of headline growth highly unreliable. Singh's first term coincided with an exceptional global liquidity and commodity boom. This external tailwind pushed growth toward 9% across nearly all large emerging markets, elevating India's performance alongside its peers. Conversely, Modi's era was hit by the 2020 pandemic lockdown, an exogenous shock that triggered a severe single-year GDP contraction and heavily dragged down his era's average growth rate. To evaluate these 2 periods accurately, we need to strip away the political marketing. We have to look at the actual measurable trade-offs each leader made regarding macro stability, policy execution, and structural reform. During the 2004 to 2008 boom, India aggressively capitalized on global conditions, seeing strong domestic investment and a massive surge in IT and services exports. When the global financial crisis hit in 2008, the government responded with a coordinated fiscal stimulus. It successfully cushioned the economy from a deep contraction, but it pushed the fiscal deficit to roughly 6.5%, a level that proved incredibly difficult to unwind in the years that followed. This chart plots inflation against economic growth. Watch the Singh-era years cluster in the upper right. This expansionary environment carried a severe cost. Persistent food and fuel prices drove inflation above 9 to 11% for extended periods, steadily eroding real household wages. High inflation, combined with a widening current account deficit, left the economy highly vulnerable. When the U.S. Federal Reserve signaled a change to its monetary policy in 2013, the rupee depreciated sharply, and international investors labeled India as one of the fragile 5 emerging markets. The Modi administration responded to this vulnerability by changing the institutional framework. In 2016, they instituted a formal statutory mandate for the Reserve Bank of India to target consumer inflation at 4%. Look at the chart again. Under this tighter monetary policy, the Modi years drop into the lower left. Inflation stabilized at a 5 to 6% average, and foreign exchange reserves more than doubled, eventually surpassing $640 billion. The macro trade-off is clear. Singh ran a globally fueled growth engine that struggled with inflation and external vulnerability. Modi built a highly resilient macroeconomic framework, but the trade-off was lower pre-COVID growth momentum. Singh governed through multi-party coalitions. This structural constraint required continuous negotiation, resulting in a cautious, technocratic, and consensus-seeking policy approach. This consensus model enabled sweeping, rights-based social legislation. The government passed statutory guarantees for rural wage employment, education, and food security, which coincided with a massive drop in the poverty headcount ratio. However, the system relied heavily on discretionary, non-transparent resource allocations. This vulnerability erupted into the 2G spectrum and coal block allocation scandals, severely damaging public and investor trust. The fallout was a highly risk-averse bureaucracy. Officials stopped signing off on new projects out of fear of prosecution, stalling large infrastructure investments in what became known as policy paralysis. The Modi era operates under a completely different governance structure. Backed by an absolute parliamentary majority, his administration utilizes a top-down, executive-driven approach. This executive-enabled direct benefit transfer system to reduce welfare leakage. It also forced through the long-delayed unification of the country's indirect taxes via the GST. But unilateral power carries unvetted risks. In November 2016, the abrupt demonetization of 86% of the currency by value severely disrupted the informal sector and short-term GDP, while failing to achieve its primary stated goal of eradicating black money. Governance style dictates outcomes. You have the slow, easily corrupted consensus of coalition politics on one side, and the fast, highly disruptive force of executive fiat on the other. Despite these contrasting philosophies, both administrations failed to solve the country's core structural economic challenge. This line graph tracks manufacturing as a percentage of GDP from 2004 to 2024. Through 2 decades of policy shifts, the manufacturing share remained stubbornly flat at roughly 15 to 16%. Modi's targeted combustion-linked incentive schemes have successfully boosted electronics and smartphone assembly, but this push has not yet resulted in the mass, economy-wide supply chain deepening required to transform the broader labor market. The root causes survived both governments. Complex labor laws, severe friction in land acquisition, and logistical bottlenecks continue to restrict mass industrial expansion. The result is 20 years of jobless growth. Formal employment creation consistently lagged behind headline GDP expansion, regardless of who held the Prime Minister's office. A rational assessment doesn't yield a definitive winner. The better era depends entirely on what you prioritize as an observer, voter, or investor. This scorecard maps the trade-offs. If you value rapid economic expansion, high global liquidity, and broad statutory safety nets, and are willing to tolerate high inflation and external vulnerability, the Singh era aligns with your priorities. If your priority is a resilient system with strict inflation targeting, massive foreign reserves, and digital formalization, then the Modi era's stability provides the better model, despite its lower pre-COVID growth and unvetted structural shocks. Keep in mind, whichever path you prefer, both eras face serious, unresolved critiques regarding crony capitalism, from the discretionary allocation scandals under Singh to the massive market concentration among large conglomerates under Modi. Their crisis management and governing styles were total opposites. But as we look ahead, the defining challenge for India's next economic era remains generating the mass industrial employment that both Singh and Modi left unfinished.